every country on Earth carries debt. The United States owes more than $36 trillion to bondholders, foreign governments, and its own citizens. Japan's national debt exceeds 230% of Japan's entire annual economic output. Global debt hit a record $348 trillion at the end of 2025, according to the Institute of International Finance. Nearly $29 trillion was added in 2025 alone, the fastest single-year accumulation since the pandemic surge. The OECD has called the current debt environment the most dangerous moment in modern financial history. Understanding sovereign debt means understanding who benefits, who suffers, and why the system never resets. Sovereign debt is the money a national government borrows to fund operations it cannot cover through tax revenue alone. Governments issue bonds, formal IOUs, that investors purchase in exchange for regular interest payments. When a government cannot afford bond repayment at maturity, the standard solution is to issue new bonds and use those proceeds to pay off the old ones. Economists call this rolling over the debt, a phrase that sounds routine but describes a precarious financial tightrope. A country rolling over sovereign debt is, by definition, borrowing money to repay money it already borrowed. The total balance never shrinks. Only the ownership of who holds the debt changes. Japan, France, the United Kingdom, and the United States all operate on rolling debt structures that have not been net paid down in decades. Sovereign borrowing became normalized after World War II, when the Bretton Woods system established the dollar as the world's reserve currency. The IMF and World Bank were created at Bretton Woods explicitly to finance countries unable to access private capital markets. The shift into crisis territory came in the 1970s, when Western commercial banks recycled petrodollar revenues into large loans to developing nations across Latin America and Africa. International interest rates spiked in the early 1980s as the United States Federal Reserve fought domestic inflation aggressively. Countries that had borrowed in dollars suddenly faced repayment costs that had doubled or tripled through no fault of their own policies. The 1982 Latin American debt crisis exposed how fragile sovereign borrowing becomes when external interest rates move independently of a debtor nation's capacity to pay. The pattern established in 1982, emergency loan, austerity conditions, temporary stabilization, repeat, has not fundamentally changed in 40 years. IMF loan conditionality, the policy requirements attached to every rescue package, has drawn sustained criticism from economists across the ideological spectrum. Structural adjustment programs mandated cuts to healthcare, education, and public sector wages as conditions for receiving loans. Those cuts reduced the very economic capacity a country needs to grow its way out of debt. Argentina entered its first IMF program in December 1958. Argentina has now completed 23 IMF programs across nearly 7 decades, a record unmatched by any comparably large economy. Every rescue package was followed by a period of apparent stabilization and then a new crisis deeper than the one before. Critics argue the IMF structure benefits creditors first and debtors second by design. Sri Lanka's 2022 collapse became the most dramatic sovereign debt failure of the post-pandemic era. Foreign currency reserves dried up, fuel shortages triggered 12-hour power blackouts, and citizens stormed the presidential palace. Popular narratives blamed Chinese loans and the Hambantota port. But that story is more complicated than those narratives suggested. Sri Lanka's government initiated the Hambantota project independently. The United States and India were both approached for financing and declined. Chinese debt represented only 9% of Sri Lanka's total government obligations at the time of default. The majority of Sri Lanka's debt was held by Western institutional investors in international bond markets. When Sri Lanka could no longer service Hambantota debt specifically, the government leased the port to China merchants. Port holdings for 99 years in exchange for $1.12 billion. Sri Lanka retained full land ownership and 43% of port profits under that agreement. Hambantota has since become one of the fastest-growing transshipment hubs in the Indian Ocean. The debt trap diplomacy framing applied to China describes tactics Western creditors normalized decades earlier. Zambia became the first African nation to default during the pandemic, missing a $42.5 million Eurobond payment in November 2020. Zambia's debt included Chinese state loans, Eurobonds, and multilateral development bank financing simultaneously. Restructuring took more than 3 years because Chinese creditors, Western bondholders, and multilateral lenders could not agree on shared terms for losses. Zambia's citizens endured austerity and currency depreciation while creditors negotiated among themselves. The Zambia case revealed that international debt restructuring has no binding legal framework comparable to domestic bankruptcy law. When a company goes bankrupt, courts oversee creditor claims according to established legal priority. When a country defaults, restructuring depends entirely on voluntary negotiation among parties whose interests rarely align. Argentina has defaulted on sovereign obligations 9 times since independence. Each default followed a recognizable cycle: cheap credit, rapid debt accumulation, currency crisis, IMF intervention, austerity, partial recovery, renewed borrowing. In May 2020, Argentina defaulted on approximately $324 billion in sovereign debt, around 90% of GDP. In 2025, Argentina secured its 23rd IMF program, a new $20 billion agreement, while operating under the most aggressive austerity conditions applied to a major Latin American economy in recent history. The fundamental question Argentina poses is whether the cycle can ever actually end, or whether each restructuring simply resets the clock on the next crisis. The assumption that debt traps are an emerging market problem collapses immediately when examining wealthy nations. The United States federal government spent $970 billion on net interest payments in fiscal year 2025 alone. American net interest costs in FY 2025 exceeded the entire U.S. defense budget for the same year. Japan carries a government debt to GDP ratio exceeding 230%, sustained partly by the Bank of Japan purchasing a significant share of its own government's bond issuance. The critical difference between a rich nation debt trap and a poor nation debt trap is not the structure, it is the currency. Countries borrowing in their own currencies retain the option of monetary expansion. Countries borrowing in foreign currencies, dollars, euros, or yuan, face hard repayment constraints with no monetary escape valve. Currency asymmetry is the single most important and least discussed factor separating survivable sovereign debt from catastrophic sovereign debt. When a country genuinely cannot repay, the sequence of consequences follows a predictable pattern. Missed bond payments trigger credit rating downgrades that immediately raise borrowing costs for all future debt issuance. Currency depreciation follows as investors exit local bond markets and convert holdings into dollars. Depreciation then raises the local currency cost of dollar-denominated debt simultaneously, accelerating the spiral. Governments introduce capital controls, restricting citizens from moving savings into foreign currencies. Austerity programs cut public services at precisely the moment economic hardship is most severe. Social unrest follows. Sri Lanka's 2022 palace storming, Argentina's 2001 riots, and Zambia's 2020 default all followed this arc within months. Countries that default while maintaining strong domestic institutions, like Iceland in 2008, tend to recover faster than countries accepting extended IMF austerity programs. Debt cancellation has historical precedent. West Germany's post-World War II debt was canceled by 50% under the 1953 London Debt Agreement. Germany only had to repay remaining debt from trade surpluses, meaning repayment was conditioned on actual economic health, not imposed regardless of it. Germany's creditors accepted those losses because sustainable German recovery served long-term international stability better than perpetual debt servicing. The G20 Common Framework, established in 2020 to coordinate sovereign debt restructuring, has produced limited results because private creditors hold no legal obligation to participate. The $348 trillion in global debt recorded at the end of 2025 will not be repaid through conventional means. The debt will be restructured, inflated away, partially canceled, or, in the worst cases, defaulted on at scale. The question is not whether the system will eventually reset, but who will absorb the losses when it does. The answer, historically, has almost always been the same: the people least responsible for accumulating the debt in the first place. Has your own country ever had a close call with sovereign debt? And did the government ever tell citizens the truth about how close it came? Leave that answer in the comments, because the next World Stages video explores how central banks actually create money and whether the entire concept of government savings is a financial illusion. Subscribing to World Stages means never watching a budget headline the same way again.